Well, good afternoon, everyone. I'd like to firstly start by welcoming and thanking the speakers for giving up their time and sharing their expertise today, and especially to the students, both past and present, both of which we'll all be listening to this UniSA Property Students webinar with industry leaders. So my name is Philip Beaton. I've been a lecturer here at about 20 years. I'm a fellow of the Australian Property Institute. I'm a CPV and very passionate about helping our students and of course passionate about the industry. So I'd also like to acknowledge the University of South Australia is on the traditional country of the Kaurna people of the Adelaide Plains. We recognise and respect their cultural heritage, their beliefs and relationships with the land, and we acknowledge that they are continuing importance to the Kaurna people living today. Just as a bit of a background for our students that are listening right now, this Sydney trip has become a bit of a folklore for this discipline, and some of you have been on this Sydney trip many moons ago. But in the 80s and 90s, the third year students all were sent to Sydney either by bus or plane or whatever, and we spent about 7 days there and learnt lots, had a fair bit of fun, and had a lot of interesting times, and we're exposed to all these sort of wonderful jobs that many of you now, part of. And so that's what we wanted to continue. So a couple of years ago, Joe, one of our lecturers here in the property discipline, sort of reinstituted this. And so we've had a couple of Sydney trips, and of course now we're doing it by COVID. So, you know, the emphasis here is to excite our students about the property industry and expose them sort of jobs that are available in this industry, both locally, nationally, and internationally. And we'll hear about that today and tomorrow. But before I introduce our first speaker, I'd like to note the following. The webinar will be recorded. The recording will only record the speakers. The recording will not show participants or any questions in the chat area. Each panel member will speak on the topic, and we will then ask them to answer questions which the students have submitted when they registered. Please note that we won't be responding to any the live chat or raised hand function, as we've got so many that would be difficult to administer. So, so this session is over the two days. We've got a number of sessions. The first session is about investment banking career pathways. So we'll hear from three industry experts on this, starting with Justin Blaise. So Justin is Principal and Portfolio Manager of key global investors. He has a broad and extensive background in investment management, investment banking and equities research. Prior to co-founding key global investors, Justin was part of the Deutsche Bank's real estate investment banking team in Australia. His corporate finance experience, including a prior role at Merrill Lynch, extends to equity and equity-linked capital, market transactions, mergers and acquisitions and debt arrangement, including involvement in international real estate transaction. Justin is a graduate of this wonderful property degree of ours at UniSA. And so Justin, it's over to you.
Thanks, Phil. My name is Justin Blaise, and I finished my property degree in 1994. I've been living in Sydney since 1997 and have worked a large part of my career in investment banking. What I'm going to talk about today is I'm going to discuss my journey, an overview of what I do today, what roles I've had in my career so far, and then my advice to starting a career in real estate finance related roles or investment banking. And at the end, I'm also happy to take questions. My journey, as I said, started in 1994. I finished the Bachelor of Business Property, interestingly, during Australia's last recession. I was hence drawn to the East Coast to look for opportunity. That started as a role as a cadet valuer in Cairns, Queensland. Wasn't somewhere I wanted to end up forever, so at the same time I started studying finance as a postgraduate. And in 1997, I moved to Sydney with a job offer to join what was then HSBC James Capel as an equity research analyst, analysing the listed property trust sector, or as it's known today, A-REITs. I certainly wasn't an A-grade student. In fact, I took 4 years to do a 3-year degree. Now, while working as a cadet valuer in Cairns, I was motivated by the career opportunities I discovered that existed in investment banking. And this drove me to postgraduate studies, to tenaciously hunt for a role within investment banking, and then to ultimately move to Sydney. Today, I'm a part owner in an asset management or funds management business that invests in global real estate securities. I established key global investors with a prior work colleague and with financial and operational assistance from a large family office based in Melbourne. We currently have approximately $250 million of funds under management on behalf of institutions and individuals. And the way we earn our revenues, we charge a fee for managing and investing that money. That money is currently invested in listed real estate entities around the world, including the US, UK, Europe, and Asia, and in asset classes as diverse as data centres, self-storage, healthcare real estate, and residential apartments and homes as some examples. And with my business partner, I'm responsible for all the investment decisions relating to client monies, as well as managing and growing the business. I started the business in 2013 after a 15-year career in investment banks, including Deutsche Bank, Merrill Lynch, and ING Investment Management. The prior roles within these investment banks included principally equity research and corporate finance. Equity research as a job involves analysing listed companies, and in my case, REITs, and advising relevant stakeholders on whether the REITs represent a good investment. Those stakeholders are predominantly fund managers, like me today, but also include the equity sales desk and other divisions within the bank, such as the corporate finance team. In equity research, my role consisted of meeting with REIT management, touring assets and operations, building financial models, including profit and loss statements, balance sheets, and cash flow forecasts. From that, undertaking valuation of the security or shares, report writing, marketing my opinions and findings. That role also required extensive travel, domestic mainly for visiting operations, and global for visiting clients. My corporate role, finance roles, consisted of managing the bank's relationships with listed REITs. That also included advising senior executives of these listed REITs, including the CEOs, CFOs, and the boards on strategy, as well as managing merger and acquisition transactions or capital raise, be it debt or equity, and in conjunction with other divisions within the banks. It is a role where gaining trust, attention to detail, and a sense of urgency are paramount. I moved to corporate finance after 7 years of equity research, which is quite a common career path. Equity research provides an excellent training ground and stepping stone for corporate finance, and in fact, many other related roles in the listed real estate finance world, such as funds management. I was actually ultimately made redundant in the post-GFC period, and that was the catalyst for setting up my own business. In both roles, equity research and corporate finance, in my opinion, they require a high level of financial literacy, good interpersonal skills, and a willingness to work, and sometimes at non-conventional hours. But both roles provide a fantastic training ground and network of contacts that gave me the confidence to launch my own business in time. My advice for getting a career in investment banking: don't be despaired by the current economic conditions or the lack of apparent exciting opportunity. Now, when I was at university, it was a recession. I didn't know any of the jobs that I ended up doing even existed. Be flexible, be willing to consider roles outside the traditional areas of agency, valuation, and property management. Be tenacious. In 1997, I made many cold calls, often to no avail. Don't take rejection personally, and be willing to move. Unfortunately, in investment banking, most roles are on the East Coast in either Melbourne or Sydney. And also be willing to learn. Postgraduate is inevitable in the world of investment banking. Courses such as CFA or finance does increase your value. and be patient, because success takes commitment and time. And that's really all I have to say today. So good luck, and thank you for listening.
Well, thanks very much, Justin. Just on reflection of that, you seem like a kind of an excellent case study. You know, taking 4 years to do a 3-year course. Well, you're obviously very thorough. That's what you meant, wasn't it? You wanted to be thorough and get to know those subjects really well.
That's exactly right.
But for the students on looking, probably what it does give you is, you know, example of, you know, maybe I shouldn't say this, but we don't have to be absolute rocket scientists to be very successful in property. But what Justin has showed us is that we need attention to detail. We talk about that quite a bit in the course. So I'm trying to relate this to our students and what they're studying as well, and why they might be listening to this. But, you know, you've talked about investments, investment research and analysing, your you know, your ability to analyse figures, your literacy, your numeracy skills. And then down to some marketing, like cold canvassing. I guess we all know that have been in business, and I have as well, that not often do great opportunities just sort of knock at the door and say, hey, you know, I'm going to be your biggest client. We've got to sort of fight for it. So in the same way to our students that are listening, we've got to go out there and basically market ourselves, I suppose. And in your increasing knowledge of property, you'll be in a good position to do that. So thanks, Justin, for that, and you can relax now.
Thanks, Phil. Pleasure.
Okay, I would like to now introduce you to Drew Bowie. Drew's Managing Director of Molus Australia, and of course we've got lots of people, and he's got the famous Chris Monahan right next to him there. But we know lots and lots at Molus, of course, and we can't exclude Andrew Pridham. But Julian Biggins was a student of mine many years back, and he was a brilliant young man, and he no doubt is a brilliant middle-aged man now. Okay, so Drew is a Managing Director of Molus Australia in asset management. He's a credit asset management specialist and has over 25 years in real estate credit, portfolio management, and capital market experience across multiple asset classes. Drew has successfully completed an extensive array of development and investment portfolio finance facilities, incorporating senior and structured credit and equity participations both in bank and non-bank institutions. So Drew, it's over to you. Drew.
Thank you, Philip. And you must be a very, very good teacher, noting your comments around Julian. And I say that with a great deal of confidence in the fact that he is my boss. So,
yes, he's a brilliant young man. In fact, he actually asked me to sit next to his parents when he graduated, and I felt quite honoured. I'm still honoured to have been asked that. So anyway, over to you, Drew.
Well, that's lovely. And like many of your students listening today, I started out with a pathway the same as that. I studied land economics before moving into finance, which I'll get to. But one thing that I haven't learned very well, and that is technology. So I'm going to attempt to share a presentation for two reasons. One, because it was prepared by one of your alumni, somebody I employed 2 years ago. And secondly, so you don't have to look at me for the duration. So just give me one moment. Right. Now, can you perhaps see my screen at the moment?
No.
Okay.
I can see you, Drew, and of course, Chris.
Yes, okay.
Technology's not kicking in yet.
Okay. How about...
Okay, I'm with you. I've got plenty of helpers.
Right. How about that?
Yeah.
Is that working?
That's working.
Good. You can see my slideshow. You can probably see all the... hang on, from current
That's
slide.
all right.
Start from this side. This will work. How's that?
That's brilliant.
Hey.
You're on an HD at this stage.
That's good. Okay. So that's, I guess, the first interesting bit, I hope. that is, my pathway started out as a land economist, to start off as a cadet valuer, training in Sydney here, and across valuing a multitude of different asset classes, all the way through to rural properties, residential, pubs, commercial buildings, office, industrial buildings, retail, right across the whole gamut of the real estate sector, which was invaluable ultimately to what I'm doing now. I was a valuer for 4 years, and you'll see there that I'm also a fellow of the Property Institute, for which I take great pride. I also, subsequent to that, for my own interest, really, I completed a Bachelor of Commerce with a business law major. I just thought it was a nice adjunct once I had moved into the banking world. So I moved into finance with Macquarie, not necessarily to pursue a career in real estate finance, but really to pursue a career with smarter people than myself. And I always thought that that would position me well. That was going to be a path of greatest learning. And indeed, I still pursue a path of greater learning, which is why I joined Moelis 3 years ago. I believe, and I believe then, and I still believe now, that it was an organisation, or it is an organisation of very good minds. And I'm 50 years old now, so I've been doing it for a while, but you never stop learning. And that's sort of something I think to take with you right from the outset, as to the sort of the career that you might follow, not to jump into what may be the easiest path now, but something that will challenge you. But then in this short session, I'll just talk a little bit about my pathway. I'll talk a little bit about why I enjoy greatly doing what I do. I'll talk about what I am doing and various pathways into investment banking. What I enjoy most in that list there, the day-to-day, is probably the fact that I meet with such a broad range of people. We are in a people industry. You interact with colleagues, you interact with clients all day, every day. I can go from a meeting with the most sophisticated private equity institutions who might be managing many billions of assets. My very next meeting might be with a property developer who may or may not be wearing long pants. And so to actually understand the mindset, to be able to communicate effectively with that broad range of people, is something that I take the most value from. And it's a skill, it's one of those soft skills that sort of Philip was mentioning, and Justin touched on too, that it's not just about the academics. I remember when I joined Macquarie, I was quite fearful of not being smart enough, to be honest. Sometimes I still hold that fear, but it's more those soft skills is the real challenge of what we do. The numbers are the numbers. It's not highly sophisticated, the calculation of numbers and what we do, but it's understanding the emotional attachment to property that people have, whether it be through institutions or through private wealth. So that's I guess what I enjoy the most about what I do. The typical career progression, I guess, people typically start off as an intern. This is essentially what I did: intern, analyst, associate, just working all the way through. But what makes it successful, as Justin mentioned, you got to be willing to put in the hard yards, but don't be fearful about that either. You do it. People put in the hard yards because I find, because they create a culture. Their friends, their colleagues become their friends. I remember working extraordinarily long hours, but my choice was to go home and watch something pretty boring on TV, or to work in a project with colleagues that you get really enthusiastic about, and this this sense of achievement that you develop through working hard with your colleagues. You do need a high attention to details. You need to be collegiate, that good team environment. Sure, you need, some strong accounting and finance knowledge. You need to be able to pick up what people are saying in meetings, etc. But strong interpersonal skills, I think, are the key. Good academic credentials, having potentially that continuation of learning will always put you in really good stead. Who you deal with, this is what I mentioned. This is what I find the most attractive thing about what we do, this people industry that we're in. Dealing with highly sophisticated institutions within investment banking, the service providers that you'll deal with, the law firms, the valuers, the agents, all the way through to builders, to quantity surveyors, to consultants, to the real estate industry. There's obviously a lot of touch points that real estate has for so many different people, and you get to deal with many of them. Mortgage brokers, research agencies, the whole lot. So it's that broad church of people that I've mentioned. And it's also a broad range of assets, and I'll get to this in a moment. Just some touch points as to what I deal with on a day-to-day basis. But in my world, I go from working on those big shiny assets, big commercial high-rise buildings, all the way through to really small opportunistic type projects. There can be those portfolio acquisitions where we're dealing with multiple assets, or it could just be one-off deals, multiple geographic regions. And I like the fact that everyone has an interest in real estate, and that's why it's important for investment banking. One of the things about the role that investment banking is playing in real estate, in my space, which is the financing of real estate, that's been a domain typically of the major banks, and that is becoming less and less so, and that is because of the regulations that the authorities have on the major banks, which mean they have to contract their exposure to this sector in their lending balance sheets. And typically in investment banking, when a gap is created in the market, investment banks are very quick to fill it. And that's an opportunity that you may wish to consider for your career, being in real estate credit. Real estate credit, what is it? Where does it sit? Really, it's in the senior debt and the subordinated debt part of the capital stack. You'll see that this will be very familiar to you, the way that real estate is funded. But I play in the sort of the senior debt and the subordinated debt space, mainly the senior debt, and that is typically the largest part of the capital stack, and it's part of the capital stack where it's the most conservative. It's lower risk, therefore lower return. But that doesn't mean it's without control or it's boring. You can have a pretty significant role to play in the credit space in real estate. So where are the opportunities across real estate investment banking? Well, the key areas, and this is not all the areas, but the key areas: equity capital markets. What do you do in equity capital markets? You might be raising capital to fund growth, to reduce debt, to strengthen balance sheets. There's IPOs, M&A, restructuring advice. That's all pretty intensive investment banking stuff. It's very creative and very rewarding. Debt capital markets is sort of raising the debt through the private and public markets, as I've said there. They sort of deal in big licks of money, deal internationally, and that's a market that really came to the fore in the global financial crisis, when capital was really scarce. Those that operate in debt capital markets who could source capital did amazingly well. In fact, in many investment banks, debt capital markets really thrived through that global financial crisis. And you could really, I was actually in that space at the time, and you could really charge whatever you wanted for the provision of debt capital. Loan markets, so this is more traditional loans to borrowers. They come in big and small. Ideal in loans as small as $250,000, and ideal in loans as high as they get. So we've got capital, for hundreds of millions of dollars, if not billions of dollars. So there's a very, very wide range of deals that you can access through a job in loan markets. And then there's asset management, and that's really creating investment opportunities to package up and to sell down to other people. And once again, that can be in the equity markets or the debt markets. That's a little bit more about real estate credit, but I think you probably understand it. The credit space is last money in, first money out, which is why I like it, because credit's a defensive investment strategy, which works particularly well in highly volatile markets. Certainly in the recent period of COVID, we saw a flurry of new capital come into the credit space as people want to take risk off their equity positions and park it in a more stabilised yielding environment that credit offers. We did see some people pull out of credit and try and take opportunities when they thought that the market had bottomed out in equities too. So it's that constant trade-off, and there's always a relationship, as you'd expect, with credit investors and equity investors. A bit of what I'm doing, and indeed something that one of your former colleagues, Aria, looks after for me now is a series of discretionary credit funds. So what those funds provide essentially capital to invest in first mortgage loans. What I like about this is we are dealing with a huge array of loans on a day-to-day basis. So I've thrown this chart in just to show you the fact that we're dealing with residential, we're dealing with hotel and leisure, retail, industrial, right across all sectors of real estate, which we find interesting. That particular fund, 260 million, average loan size of $5.1 million. So you can sort of get a sense from that, and average maturity of 9 months. So these are investments that we're making into first mortgage loans, average 9 months, so they churn really quickly. We see lots and lots of deals. So rather than sort of focusing on 1 or 2 large deals in a year, we are doing 3 or 4 deals a week. And that's interesting because we're dealing with lots of different people, but seeing lots of different transactions. On the flip side, we also provide funding for much larger projects. You may recognise this particular tower in Adelaide called Realm, which was only recently completed. So we provided the funding for that tower. I would attend project control group meetings every month with the builder, the architect, the quantity surveyor, the superintendent, project manager, the borrower, a whole range of different people. And one of the skills that I have developed in the career that I've chosen is really understanding development finance, and to be able to walk a development site, get your boots dirty, understand where the risks are in construction delivery. And as I mentioned earlier, the major banks are pulling out of this sector, and which means it's an opportunity for us to fill in. And there's actually not all that many people with the skill sets in the finance world to actually understand the risks associated with construction and to manage that construction risk. It's surprisingly few. There are a lot of investment bankers who are providing real estate finance, but do they actually understand the underlying real estate? It's an opportunity for you in that space. We don't just look at individual transactions in the world that I live. You know, we're looking at sort of macro trends, cyclical behaviour. We look at government policy, how that might affect values in the immediate and longer term future. So we're always applying a great level of research and data, and you know, it's more than just about understanding a small, you know, property asset. It's about more macro environments, and that's a skill set that I think is aided by a role in investment banking, because those institutions are very heavily focused on research and data driven. That's something that I enjoy as well, and really gives you a lot of continued growth in your own knowledge around how markets operate. This slide, not quite sure why Aria put this slide in actually, but he put a lot of work into it and I like it. But this is just going, this slide really goes to why real estate credit is an important asset class within investment banking. It's showing that credit provides a lower volatility than equity, and that is attractive to many investors, or at least to some of the portfolio of an investor. So there's always going to be a role or an interest in credit within the investment banking world. The decision making, an equity mindset when investing across all levels. So it's really positioning yourself as though you're using your own money to invest, and how you're going to control that investment. Understanding how other people think. You know, there's one thing to go into a meeting, and this holds very true with your interviews with potential employers. It's understanding from their side of the spectrum, you know, what sort of questions they're likely to ask, what's going to be of interest to them. It's the same with a meeting, you know, it's understanding the other side of the table. Understanding real estate, you know, when we're in investment banking, understand the asset sector that you're going to be playing in. So you'll have a head start from a lot of others trying to play in the real estate investment banking space. Is it worth it? It absolutely is. A lot of interesting people. Never stop learning. I keep on harping on that because it's really important. It does reward good business acumen. So it's having that knowledge, underlying knowledge about the sector that you're playing in, understanding how to read people. It's always evolving. It is an important sector in the financial markets. There is an opportunity to create a difference, to have a long-lasting effect, and it can be well rewarding as well. You obviously you get out what you put in, but putting in is a lot of fun in investment banking, even though it probably doesn't sound like it is. Career advice, just quickly, some tips for consideration. And as I think Justin mentioned, it won't be your last job. Your first job won't be your last. Take experience over your initial income. It will pay you back. Be patient. Crawl before you walk. You know, my first job started off, you know, I was more or less photocopying, but I was reading what I was photocopying. You learn wherever you can. Identify what skills you're likely to develop, what sort of transactions you'll be exposed to. That's a question for you to ask of your interviewer. What transactions will you be exposed to? Does that sound like something that you will learn from and be interested with? Always look to broaden your skill set. Be willing to make sacrifices. It is a dedication, but that will hold true to any career that you know you do choose. And I would recommend seeking out challenging and high energy environments. It's that sort of goes hand in hand with a lot of work, but once again, that high energy gives you a great sense of satisfaction, of reward, of pride, and you'll develop tremendous relationships, lifelong relationships. So they're my main advice for you. Thank you, Philip.
Thanks very much, Justin. Drew, in fact. Drew, that was fantastic. I really enjoyed that because you are obviously highly professional. You've now become a little more specialised in your work, but from a student's point of view listening, you know, Drew has been a valuer. He's valued probably sheep farms, cattle farms, the rural scene, pubs, commercial, industrial, and no doubt residential. And then because of his attitude of expanding, you know, up here, he's now grown into this other job that is well rewarded. And I think it's a great lesson for students to, you know, as Drew said, when he is talking to his clients, he's not just a property financier, but he understands property and understands real estate. And so that would come across, and it comes back to this knowledge is power. So he's had to, Drew has had to, you know, to gather his financial skills on top of his real estate skills, and achieve great success. So from a student's point of view, don't be too concerned about thinking that you're getting locked in when you are valuing things and, oh, do I want to do this forever? It's all build your knowledge. And so look, Drew, thank you very much again for that. It was brilliant. Now, so you can relax now, Drew. And Justin, I've thanked you twice, so you can relax too. Okay, so now we've got Chris Monaghan. Now, Chris is our final speaker in this section from Mollis, Australia. Chris is a Managing Director of the Head of Real Estate Asset Management and is a UniSA graduate. Nice to see you, Chris. Chris is a real estate and capital market specialist and has over 40 years experience. His current role involves managing and growing real estate asset management business, which includes sourcing appropriate fund investments and investment capital, both institutional and high net worth, and the establishment and investment management of real estate funds and assets. A role also involves equity and debt origination and dealing with investors, investment partners, and investment intermediaries. So, Chris, thank you very much for your time. Nice to see you again, and this is your moment.
Well, thanks, Phil. And I'd like to thank Drew for leaving me 3 minutes out of my 12 minutes. I was enjoying Drew's presentation so much, I lost track of time. So now, just before I start, I'd like to thank you, Phil, for calling me an industry leader. I've waited 36 years for that. So when I retire, I'll be able to retire a very happy and contented man. For your students that you've been very modest and you haven't told about your history, Phil and I used to work in the commercial property industry in Adelaide together in the 80s, particularly the early 80s, and Phil was one of the most respected leasing operators at LJ Hooker in Adelaide and did a really good job for his clients, and we worked together on quite a few deals, and Phil was a very good leasing man, very determined, very honourable. And we always enjoyed working with him. So the fact that he's decided to transition, to give his time to to let you have his knowledge is a big thing for you students. So well done, Phil.
Thanks very much, Chris. Would you like to finish now? Over to you.
Look, I just before I move on to what I'm going to say, I'd also like to say that we went on the Sydney field trip in 1981. We grabbed a bus out of North Terrace, and on board were Graham Martin, Jeff Page and John Cooper. John Cooper driving. Picked up a bin full of beer up at the Sterling Hotel when we picked up Quentin Shaw, and had a quite enjoyable time driving across. Had a great 2 weeks in Sydney, and where we worked hard during the day and we had a good time at night. And Shane Linford often says to me, my mate Shane, some of you might know, he said it was the best footy trip he ever went on. So it's a shame that we're doing this by internet, but maybe next year students will get another chance, Phil.
Absolutely.
So in relation, I thought I'd talk to you about people have given you feedback on their careers and what sections of a bank they work in. I thought I'd talk to you about what an investment bank actually is before I moved on to perhaps career options. And an investment bank is simply a financial intermediary which operates at the wholesale end of the financial markets. It's a middleman between companies issuing securities. And those securities are used to raise funds for the companies that want to use those funds. And it provides investors who buy the paper a return, both a cash return and sometimes a capital value return. Those financial securities can be equity securities or they can be debt securities. How do investment banks derive their income? Well, chiefly from the fees generated by being the middleman in the issuing of those securities. It also makes profits from trading those securities as well. It does not take a margin between the borrowing and the lending costs as domestic banks do, so it's a bit different. It's a bit of a value add situation rather than just lending people money to buy a house or a warehouse or a shopping centre. Investment banking skills rely on market knowledge and expertise, as Drew and Justin have told you, rather than on the strength of the bank's balance sheet. The various departments within an investment bank, when you get there, you'll have the choice of working in investment banking or corporate finance, or an equity sales, or an equities research, or an asset management. Investment banking is where you advise a client on a particular transaction that's happening, where you add value for their business or you help them through a particularly hard time, where you raise debt for them or you need to raise equity if they need to expand. Equity sales are simply stockbroking, where you're buying and selling on behalf of clients. Equities research, as Justin said, is where analysts spend inordinate amounts of time investigating companies in resources or property or wherever, and they provide a recommendation to the market on whether the company's good value, whether their gearing's too high or too low, or whether their share price will go up or down, what the future holds for them. And on that basis of that research, institutions make a profit. Institutions make an investment and hopefully make a profit. Asset management is simply where, on behalf of some of those institutions who want to grow their investment portfolios, an investment bank would provide an asset management division where we would put together transactions in the resources space or in the property space or whatever, and we would sell the equity or the debt in those transactions to institutions or high net worth investors or retail investors. In terms of the various sectors of an investment bank, they're all written down there: resources, agriculture, real estate, mergers and acquisition, recapitalisation and restructuring, capital markets, financial institutions advisory, private funds advisory, consumer and retail, energy, power and infrastructure, general industrials, healthcare and technology. Now, I'm not expecting that you'll understand what all of those divisions are, but over time, as you read more about the markets and you understand what's going in the markets, if and when you're working later on, they will become more obvious to you. But investment banks basically specialise across the whole business spectrum. And some of the names that you'll be thinking about when you're looking to work in the sector or follow up the sector later on. First tier banks in Australia are UBS, Credit Suisse, Goldman Sachs. These are names that are what we call bulge bracket international businesses, and they'll be well known to you. JP Morgan, Bank of America, Merrill Lynch, Citibank, Morgan Stanley and Macquarie Bank, and we've got Moelis Australia sitting in the first tier. We may not quite be there yet, but we're certainly hoping to get there at some point, and we're probably, in terms of quality, we're probably up there anyway. In terms of the second tier banks, CLSA, Jefferies & Co, Rothschild, Barclays, RBS or Royal Bank of Scotland, RBC, Royal Bank of Canada, BNP Paribas, Investec, Houlihan Lokey, Lazards. Now, you would have heard of these. You may not be too familiar with them, but they're the key players in the investment banking sector in Australia and around the world. And thirdly, I haven't got third tier, but I've got the domestic banks. National Australia Bank, CBA, ANZ and Westpac. Now, they specialise in lending money to people predominantly. Institutions, businesses, people. They do have investment banking departments, but they would probably be supporting the business banking sector in analysing the assets that the bank would be lending against rather than creating new transactions. So there's just some of the names that you can consider. In terms of investment banking itself and my career, look, the thing that you need to understand is there are many ways to work in the investment banking sector and to make your way into the sector, and it doesn't really matter whether you decide to finish the course, fly to Sydney and Melbourne, spend your time here applying to get in investment banks and start as an intern, or whether you take up a position in the business sector now and gain some experience and try and come in that way. Both Drew Bowie and myself, I'm not sure about Justin, but both Drew Bowie and myself, and I see Grant Harrison there, one of my colleagues, ex-Knight Frank colleagues, he's done the same thing. You know, we built a career outside the investment banking sector and were fortunate enough to slide across into the sector later on. And so we've effectively had a couple of careers, but some people come here and are lucky enough. But at the moment, if you want to apply for an internship bank, you know, banks each year will have an intern program where they might hire 10, 15, 20 people. They might get anywhere from 500 to 1,000 applications each time. You've got to go through very detailed interview process and psychological testing, et cetera, et cetera. You've got to have really top marks. It's a bit harder now than it was 25 years ago. And, you know, so don't be frustrated if you can't get into the sector now. Build a career, do a good job in whatever sector you're in, and you can still come across in your 30s, even your 40s, as Drew and I have. So I recommend you think about that. In terms of me, look, my role currently is Head of Real Estate Asset Management at Moelis Australia. We are listed on the stock exchange. We're capitalised at 600 million. We operate a series of funds which invest in property sectors in the asset management side. These funds are capitalised both by debt finance from domestic banks and equity finance from institutions and high net worth clients. These funds provide returns to investors which are both income-based and capital. So, you know, and my particular part of the business is real estate. So we look to provide a cash return of anywhere from 5 to 10% to our clients, and we hope for capital going down the track. You know, each year rents go up, capitalisation rates hopefully stay the same or firm, and you get valuation increase as well as a good cash flow. And that's the thrust of our business. And institutions right across the world are looking for safe exposure at the moment as markets get a little bit volatile coming out of COVID. So a significant proportion of our business is offshore, and I'll talk to you about those in a minute. But all of our funds are unlisted at the moment. At some point, we'll have a group of funds listed on the stock exchange as our business grows further. Overall, in the asset management division at Moelis Australia, we manage $5 billion worth of assets and rising. Look, you've heard about a few career paths. I've mentioned to you that there's a number of ways into investment banks. My career path started in the 70s. You know, I got a cadetship at the Value General's office at the state government, so I decided to start time. They paid for the study and I worked as well. So unlike Justin, I took 6 years to do a 6-year course, but it was 3 years full-time, 6 years part-time, and I worked at the Value General's office. As soon as I got my degree, I started applying for jobs in the private sector, and I got a job as a valuer at Knight Frank under Jerry D and John Kenny, and worked there for a year. And that was quite intense, and that was a good grounding, but I thought a year was enough, and I applied for a leasing position in the commercial and industrial department, and then quickly did some leasing for a few years, quickly made my way into sales and ended up doing city sales CBD sales at Knight Frank, and on the board of Knight Frank by the end of that decade. And then in the 90s, I moved to Hooker Corporate in Adelaide. I was managing director and an Australian board member there for a few years. Then in 1995, we attempted to do a transaction with Andrew Pridham and UBS on a property in Adelaide. The transaction didn't happen, but not long after that, Andrew Pridham rang up and offered me a job, and they needed a particular skill set up there in relation to property. And so I came up, and from 95 to 2006, I worked in the investment banking department at UBS. When I joined in 1995, the listed property trust sector was only capitalised at $10 billion in Australia, and it comprised GPT, Lendlease, and Westfield. AMP, Colonial, National Mutual, AXA, all held their funds in mutual funds that were unlisted, lumpy. There was a movement for them to demutualise and list their businesses. They had to get rid of their lumpy assets. So Andrew Pridham decided that he would start to speak to all these mutuals about listing their assets on the stock exchange, in which over 3 or 4 years they did. And that started the growth in the listed property trust sector. There was minimal research in the sector in '95, and Andrew Pridham hired John Carter and Mark Stein. Very quickly, we were dropping research on institutions' desks at 8 o'clock every morning, and all of a sudden there was transparency in the market information, and these institutions started buying listed property trusts. They got more confidence in the sector, and we could raise more money. By the time when I got there, it was $10 billion. When I left in 2006, there was a team of 10 of us. The listed property trust sector was capitalised at 120 billion. We had a 65% market share, and that was simply because Andrew Pridham decided to specialise in the space. No one else was specialising. If you're at Morgan Stanley and you advise BHP, one day you might go and raise $10 million for Gandel the next day, but they didn't specialise in the property sector. Because we did, we got to jump on the market, and it put us ahead of the other investment banks. So Andrew Pridham showed a lot of foresight, and he's still showing foresight to this day in building banks like Moelis. In 2006, I left UBS. It says 2016 to 2017 there, but it was 2006 to 2017. I decided to set up Armada Funds Management and start my own business. I'd seen the impact that the capital markets had on businesses and on property. So I thought maybe we could build on the buy side, which we did. And in 2017, we had 800 million under management. Moelis came along and bought our business. And now we've got over $2 billion worth of assets under management in our particular section and growing. And now I run the real estate asset management division of Moelis. But as I said, like Drew, I started outside the sector and worked my way in mid-career. And whilst I was a bit fortunate, but I also had done some transactions with people that worked in the sector. So that's what happens when you work in the real estate sector directly in the commercial space. You find you have relationships with people in a whole lot of other different sectors, investment banking and banking. And you find after a while that you become familiar with what they do, and if an opportunity arises, come in midstream. In terms of what is asset management, what do we do? I think you're fairly familiar based on what you've heard already from Justin and Drew, but we offer investment management services for real estate, for credit and for equities. We operate, asset management operates on what is referred to as the buy side, whereas corporate advisory and equities operate on the sell side. The buy side is when you're involved in buying financial assets or products on behalf of investors and managing for them. Sell side is where you're selling financial stocks to investors. In asset management, investment banking, you basically earn a fee for every transaction you do. And when you get to the end of the year, you have a good year, you get paid a bonus. Next year, you've got to start again. The good thing about asset management is that you get ongoing fees. When you bring an asset into your asset management portfolio and you manage it for the client, you get ongoing fees, you get annuity fees. So you get fees every year and you manage the same asset and you give your clients a distribution and hopefully capital growth. You make money while you sleep, I suppose is another way to put it. But so we have recurrent fee streams. We get acquisitions every time we do a transaction, but we also get reliable and forecastable income flows for 5 to 7 to 8 years. And we get ongoing relationships with clients. When you manage assets for somebody, you develop very good relationships, and it helps you, they get confidence in you and you buy more assets for them. So asset management is a particularly good part of the business, and I've always liked it. The next page just talked more about what asset managers do. You maximise investment value, you manage investment funds on behalf of investors. I've covered this. Provide downside protection. So you're always trying to mitigate investment risk by extending leases and getting fixed rent reviews and finding new tenants in vacancies and things like that. You provide investment management services, which involves acquisition and divestment you manage distributions, you orchestrate the fund administration processes like the constitution and the trust structuring and the arrangement of unit holder meetings and resolutions. And you report annually and half yearly, and you tell the investors what's going on, and you're always talking to them. You're out in the market, you're talking to them as well. Drew likes dealing with different principles in different types of transactions. We love talking to our clients all the time, institutional and private, and we have a very good relationship with them. And you know, most of the time we're delivering good news, but sometimes you've got to deliver bad news as well. And if you've got a good relationship with your client, it's a lot easier to do. The asset management process, I'm probably starting to take a bit too much time here, but you identify the investment opportunity, you align capital, you establish the funds, you identify assets, you undertake due diligence, which is very important. Then you acquire the assets, you manage those funds for a period of time, could be 5, 7, 10 years. At the end of the life of the fund, you divest those assets, you try and take a profit. But you wind up the fund, you make the distributions to the investors. Maybe you list it on the stock exchange instead of selling it. Who knows? And to give you one real life example so that you can actually touch it and feel it. One of our clients, our offshore clients, to give you some feel, Abu Dhabi Investment Corporation, we have 3 assets with. SBH Investment REIT, which is one of the biggest investment REITs in Singapore. We have 2 shopping centres with. We've got Fig Tree Shopping Centre, which was built by Westfield up down at Wollongong, and we own 50% of the Marion Shopping Centre for them. In relation to Abu Dhabi Investment Corporation, we've got Ingle Farm Shopping Centre, we've got Hollywood Plaza Shopping Centre, and we've got Arndale Shopping Centre. So assets that are familiar to you. In relation to, and their final offshore client is a group called Decker Immobilien. It's one of the biggest banks in Germany, if not one of the biggest banks in the world. They like it. They like Australia. They've often bought commercial property in Australia, and we approached them 3 or 4 years ago and suggested they look at the retail sector, and they did. And we inspected a number of shopping centres, and the one they liked was the Canberra Outlet Centre in Canberra. It was an outlet centre that was built in the GFC. It really struggled to get let. It had a really poor tenancy profile when it was offered for sale, and we bought it in 2016. It was effectively about 70 to 80% let, and it had a poor range of tenants, but they paid a reasonable rent. Since that time, we've pushed the poorer tenants out and we've brought higher quality tenants in. So the opportunity for us, we thought this was an underperforming retail property, and we thought once we brought in better tenants, it could be really a top quality Australian outlet centre, and that's what it's proven to be. As I said, we've pushed bad tenants out, brought new ones in. We've undertaken a $13 million redevelopment of the Southern Mall. We've introduced high-end retail precinct tenants, international retailers such as Polo, Ralph Lauren, Calvin Klein, TK Maxx, Swarovski, Nike, Tommy Hilfiger, Adidas, Puma, amongst others. And if you walk down that mall, it looks like you're in a high-class fashion precinct in Italy. You can buy goods there that are probably 30 to 50% of their normal price, and it's still all the high-end stuff. It's just that it's last season's, and it's a very popular shopping destination. It's the only outlet centre between Homebush in New South Wales and Essendon in Victoria. So it attracts shoppers from all around New South Wales. We introduced a major supermarket, we improved the overall retail mix, and we introduced a new mall and travellators to make it work a bit better. But essentially, we acquired that for $135.1 million in 2017. The net income then was $7.5 million. We've now spent $5 to $7 million to lift it up. The annual income is now $11 million. It's worth $180 million plus now. So there's an example of what an asset manager does and how it impacts their investors. So the investors are very happy there. And Phil, I think that's it for me. I think I'll leave you to it.
All right, Chris, thank you very much for that. It was a fantastic discussion about what Moelis does, and it's about this asset management. Our students do property asset management in Year 2. So you could take a lot of stuff from that, and I really liked the case study in the Canberra shopping centre. And it seems like, look, we've got some time constraints, so I'll make the questions brief. But I want to thank you all, Justin, Drew, and Chris, for your discussion and your knowledge. Chris, while you're there and you're on a bit of a roll, there's a question which I think you probably answered, but so the question was, how easy would it be for a graduate of business of our property degree to move into a career of investment banking? You've probably answered it's pretty tough, isn't it? Directly into the
pretty tough at the moment. I mean, you'd need some sort of intimate knowledge of someone within the bank to get an entree. But as I said, we get 400 to 500 to 600 to 700 high quality applications every time there's analyst positions or intern positions come up, and they go through a very intensive process to interview them all, and they pick the best. So look, it's tough. Having said that, Drew hired Aria directly a couple of years ago, and might want to comment on that.
Chris, just in the meantime, could you unshare your screen, please?
I reckon I'll do that for you, Chris.
Thanks very much.
Well done, Drew. That was fantastic. That bit of skill there was good.
That's right. That's right.
It didn't go unnoticed.
Over 25 years that took. So just adding to what Chris was just saying, in real estate credit, there's a burgeoning supply of or popping up new organisations, investment managers who are non-bank lenders in the real estate credit space. And that could be also a good pathway into investment banks. Investment banks themselves, there are only a few of us that actually have teams, in-house teams to manage their exposures in real estate credit. But a lot of these investment managers who have popped up over the last 5 years or so have a huge demand for people with real estate skills, valuation skills, someone who can read somebody else's valuation and make a judgment call on that. So you may want to consider the non-bank lending market as a way forward.
So it seems like, if a current student wants to get investment banking, there's not necessarily an immediate rush. They can accumulate these other skills, and that might be an easier path into the sort of roles that you have and so on.
Oh, absolutely. And a lot of investment banks are looking to employ people with specialist skills. So they only have a very small pool of cadets, if you like. So that is often, if you've got 1 or 2 years even of skills in a particular field, that's highly valued.
Right. I suppose emceeing Zoom meetings wouldn't really count too much, would they?
You're still a chance.
Hey, Justin, while you're there, I've got a question for you. This is from our student. As a part-time student who works full-time doing fly-in, fly-out work, can you advise how I best use my time at home productively while completing my degree and gain some work experience for transitioning into a career of investment banking?
Work experience working from home.
Yeah.
I'm not sure how I'd answer that one, to be honest.
No.
One thing COVID has made it very tough for to give people work experience, to provide that mentoring.
I suppose what Drew mentioned was that sort of gaining other qualifications. Don't be shy about
Absolutely.
About acknowledging that real estate is one study, property is one study, but there's other sort of ancillary skills that fit into investment banking beautifully.
Well, back when I finished, it was very common. We all went and did it was the Securities Institute, then graduate diploma in applied finance and investment. And back in the late 90s, if you didn't have that, no one would look at you at the investment banks as a base case. Yeah. Postgraduate was required, and I think it's very much necessary now.
Yeah. Thanks, Justin. Drew, just one for you. As a property and commerce, in brackets, accounting graduate, how important do investment bankers consider graduates from both property and accounting qualifications or other business degrees when looking for new people? We might have answered that, but could you comment on that?
I think the best way to think about that is to not narrow your focus about what investment banking means.
Yeah.
We have touched on just this afternoon the fact that there's a whole range of different units within investment banking. So Is it important? Is it important for me in employing someone to have those skills? No, it isn't. I'm more interested in people with good property valuation skills, knowledge, and people, as importantly, who can work with others, and you can roll out. You feel like you can roll out in front of a client, and will get on well with the team. So it's not imperative, but if you were to go into a pure investment banking sort of equity capital markets M&A type role, it may be more.
Yeah, Drew, I recall you sort of emphasising in your talk a lot about attitude in the workplace, and I suppose we all know that, you know, at a workplace we probably see our workmates, you know, more so than our partners or whatever. So we've got to be able to get on with people.
Well, there'll always be competitors with greater CVs than ourselves.
Yeah,
it's just the way it is. So, but this is a people industry. So don't give up, and you've got to make sure that you give that sense to your interviewer that you are someone that they're going to want to work with.
Thanks very much, Drew.
Phil, can I just add one thing?
You can.
I think whilst we acknowledge that it might be difficult day one to get into investment banking, it's not such a bad thing to think about coming to the East Coast, Melbourne or Sydney, to get involved in the market. You know, start to work for some businesses in Sydney that may not be investment banks, but might be a pathway in. At least you're familiar with the market by the time you do get into an investment bank. Yeah,
look, that's a good point, Chris. We have students wanting to, you know, we kind of had Sydney up there and Melbourne, and maybe some students a bit overwhelmed by the thought of to where all the experts are. But of course, we're not all experts. As Drew said, there's usually someone smarter than ourselves. It's a matter of getting along and getting the foot in the door, I suppose, isn't it?
It is.
Absolutely.
Now, look, it's a daunting thing at a young age to come into state. You know, it's something that I didn't really want to do. It was just that, you know, in the Rust Belt days in Adelaide, the bandwidth for real estate companies was declining. You know, it was a new start to come to Sydney and work in a growing growth market as opposed to a declining commercial property market in Adelaide, right? So for me, it was the circumstances of timing, but I still think that from what I've learned, you know, after 6 to 12 months and they get rid of the homesickness, they'll love it.
Yeah, that's right. All right, look, Justin and Drew and Chris, we thank you very much again. I know our students really love this sort of stuff. It inspires them. We want to inspire. Wonderful. Thank you again very much.
You're welcome.
No problem.
Thank you. Cheers. Okay. All right. So,
Sure.
Okay, just one moment. All right. So the next topic is institutional fund management career pathways, and our first speaker is another alumni party who's not here. I'll go to Grant. Sorry, I'll go to Grant. Okay, Grant, you're on. Just a moment. G'day, Grant. I think Grant, hang on, Grant.
Yeah, how you going?
I think Grant and I studied, we overlapped by a year or so. I was a late starter in life and you're probably a normal starter, so therefore you're a lot younger than me. So Grant, I'll say from the outset, so Grant, here we go. Grant, sorry. He's portfolio head of private markets at Cbus Super, where he's responsible for the development of investment strategy and management investments in property infrastructure and alternative growth. I might say, Grant, I've got a few bucks in Cbus, so I do hope you're doing a good job. It's not extraordinary, Matt, but it's all right. Grant has extensive experience investing in private markets based on a career in institutional portfolio and investment management, focused on property, infrastructure and private equity. And Grant, as I've just said, also studied the degree. So Grant, we look forward to hearing from you. Over to you.
All right. Yep. Thanks very much, Phil. Actually, I was a bit of a late starter in my professional career as well. And so I thought I'd sort of summarise my pathway and then I'll sort of talk briefly about my current role. But from the outset, you will not be able to plan your career with any great degree of certainty. And from my personal perspective, you've got to have goals, you've got to have ambitions, but believe me, the path will not be straight. That's fine. I encourage it, in fact. But anyway, so when I left high school, I'd had enough of the books. I didn't want to go near university. I didn't have a clue what I wanted to do. And so I went and got a full-time job. And Department of Lands, actually, South Australian Government, Department of Lands. And I think I sort of just stumbled across this interest in property in about 1985. And I remember as a mature enrolment, sitting down, being interviewed by Jeff Page.
Just a moment, Grant. We've got a bit of interference there. Grant, if you wouldn't mind.
Do you want me to stop? I can stop my video. Sometimes that opens up the bandwidth. I stop my video.
Well, you seem to be okay now. Shall we? Well, let's give it a second go. This is like repeating. This is like repeating a subject.
That's right. That's right.
Okay.
So I started my degree part-time as a mature age student in 1985. Took 5 years to finish it, and effectively started my professional career at the age of 29. Going into the course as a mature age student, I treated it like a job. I was pretty committed, actually, and very outcome focused. Prior to starting uni, I'd played a lot of footy down at Brighton Football Club. I'd had some good times, very good times, but I think I was prepared to sort of put my head down and actually focus at the time. So I graduated in 1990, got a graduate position with Knight Frank, and I remember commencing there as a valuer with Chris Monahan walking the floor, doing his deals, being the man that he is, and I was sort of the valuer trying to crunch the numbers in the background. But I stayed there for 4 years, got my ticket as a valuer. And I was then lucky enough to join Funds SA, which is the South Australian Government Pension Fund. And that role initially was an investment manager in charge of their property portfolio. They owned a lot of direct property at the time. And in fact, it included a stake in the Adelaide Casino, believe it or not. But I stayed there at Funds SA for 10 years, and it was an extraordinary role. It started out in property, but then it grew into private equity as well. Funds SA made a lot of investments into private equity investment funds, and I know people like Moelis are advisors to private equity managers or private equity funds, whereas something like Funds SA or a superannuation fund is an investor in these private equity funds. Anyway, I spent 10 years there. That role broadened out to be property and private equity, very much so. And so before I knew it, I actually had another string to my bow, understanding in good detail the mechanics of the private equity industry. After 10 years, I got tapped on the shoulder by an investment manager in the private equity space, a group called Wilshire Private Markets, an American-owned company whose Asia Pacific headquarters was based in Canberra. And I went there and worked with them for 7 years, and they were a fund of funds manager. In other words, we did the due diligence and made selections to invest in private equity funds and build a portfolio of private equity funds for institutional investors, your superannuation funds, as you like. Spent 7 years there, and eventually left that firm and did some consulting work with Commonwealth Super. Commonwealth Super had a merger with Military Super through 2011 and 2012, and so they had a very interesting portfolio they had to inherit from Military Super, and I went in and evaluated all sorts of property funds and private equity funds and alternative strategies, aircraft leasing and all sorts of things there. And I found my valuation skills together with my private equity broader knowledge came in very handy when you're sort of tabled a long list of funds with a real mix of strategies, and you've got to evaluate them for what they are. But anyway, in 2013, I landed my current job as, at the time it was head of private markets. It was to cover the asset classes of property, infrastructure and private equity. Once again, I had the two strings of the three strings required in the bow. I had property experience, I had the private equity experience, but I didn't have the infrastructure experience, but I had the valuation fundamental skills. I had the commercial acumen and judgment that I could employ, and therefore I was able to land that job. At the time, I was the single person fulfilling that role. I now am part of a team of 11. I manage 10 people in the team. We have considerable direct investment activity in those three asset classes as well. And so CBUS, as an industry superannuation fund, it's a not-for-profit superannuation fund, has over 50 billion under management. We have about 11% in each of property and infrastructure and about 3% in private equity. So our property portfolio and our infrastructure portfolio, that's $5 or $6 billion each in those portfolios. And as I said, we have a number of direct assets that we own there, but we also have very large stakes in pooled infrastructure funds or pooled property funds as well. And I'm sure many of the students will be familiar with those, but it's an area which I have found that you're aiming to build a diversified portfolio that is able to withstand various economic shocks through time. At the same time, which is most of the time, by the way, you're trying to maximise return. But however, when the shocks come along, that portfolio is meant to be or expected to be bulletproof. And it's quite a balancing act, especially leading into COVID. You know, we'd had a bull market for 10 years, so to speak, 8 to 10 years, and everyone's perception of risk was changing through that whole period. And what was seen as an infrastructure more recently wouldn't have been considered an infrastructure asset 7 years ago. And so you had to be very careful with keeping true to label in your asset classes. And thankfully, when we went into COVID, our property and infrastructure portfolios didn't experience any blow-ups, and I take pride that we have stayed true to our label in that regard. In our property portfolio, we focus on core long-term hold assets, assets that are in high quality locations with the physical attributes which are expected to attract long-term tenant demand. It's a bit of a judgment call in terms of balancing office, industrial, retail and whatnot. But there's also, while there's market cycles that go on from time to time, you also have to have an eye on the structural changes as well, which is exactly what retail and industrial or logistics is going through at the moment. Within our property portfolio, we have a very large portfolio of direct office assets, which is through our property development arm, CBUS Property. They have developed a number of very high quality CBD office buildings across Brisbane, Sydney, Melbourne, Perth, and that makes up about 50% of our property portfolio. The rest of our exposure is through pooled funds with ISPT and AMP and the like. In the infrastructure sector, We have a number of direct investments, for example, a small stake in New South Wales ports. We have a stake in a portfolio of ports in the UK. We have a stake in a toll road in Indiana, in the US. We've got a portfolio of wind and solar energy, renewable energy generation assets in WA as well. But then alongside that, we have very large stakes in pooled infrastructure funds that own capital city airports, capital city seaports. So I'm trying to sort of give you a flavour that my role is far different to the days of valuing a shopping centre or a vineyard or a chicken farm back in 1992 at Knight Frank. So, yeah, look, I hope I've sort of explained that my career has been quite a journey. And in summary, I would reiterate what I said. Your career will not be a set path. Be ambitious, set yourself goals, but be prepared not to go in a straight line. Be opportunistic in your career moves. Put your head down, work hard in your current role, but always keep an eye above the horizon. I spent 4 years at Knight Frank. I spent 10 years at Funds SA, 7 years at Wilshire Private Markets, and it's now 7.5 years at Cbus. I've tended to stay in position for a relatively, long period of time, but that's not to say I'm stuck in a rut by any means. And if an opportunity arises, I'll jump at it. Follow your passion, follow what you enjoy the most, because that is what you'll be best at. And if you're the best at it, you're going to get a job, and you'll keep your job, and you'll advance in your career. Constantly get out of your comfort zone. Constantly get out of your comfort zone. There should not be a day where you are not getting yourself out of your comfort zone and feeling more or less uncomfortable. If you do that, it's a personal challenge for yourself. If you do that, you will grow, and you'll have an enjoyable career, but you'll also advance. Chris Monahan and Drew mentioned this, but you'll find that people management skills will become very important as you advance through your career. You don't learn them in university, but it's something which you will have to focus on. Your ability to influence and communicate with people, backed up with good technical knowledge. But you won't get anywhere if you've just got the technical knowledge. You have to be able to present, you've got to be able to influence, you've got to be able to communicate. And I really encourage people, once they get out of university, really hone those skills. Once I was at Funds SA, I spent about 5 years going to a public speaking club called Toastmasters, where you get the chance every fortnight to hone your public speaking skills. I couldn't recommend it enough. I think personally, along with my degree, it was a major turning stone, or foundation stone in my career, to be able to communicate and influence. So I'll stop there, and I wish all the students all the best.
Look, thanks very much, Grant. That was fantastic. I really liked that, because you started your property career about 29. I started. I was very rarely do people tap you on the shoulder and say, "Hey, this is a fantastic promotion for you. You've got to articulate your ideas," and so on. And so one of the emphasis that we're pushing with students in the last 3 or 4 years continually is pressing students to make presentations in class for exactly the reasons you stated. You do have to communicate your ideas, and let's just hope they're good ideas. And it was really interesting hearing about your asset classes. We've got a speaker tomorrow called David Beaton, who I know quite well. He talks about infrastructure too, and it's interesting how your investment strategy includes infrastructure. So, the New South Wales ports and toll roads and renewable assets. So from the students listening to this, as we've said before, read about property, get engaged in property, and not just what you're studying, because it's, what you're studying is about 10% of, 3% of the world of property. There's just so many great things that you can do out there and be open up to when you graduate. So again, thank you very much, Grant. Much appreciated. Now we come to Mr. John Garrett, who's, I think the last time I spoke to John was at a very fancy and posh function at the opening of the Pridham, no, during the construction phase of the Pridham Hall. So John is, so we're going to be talking about management, fund management career pathways. John is a managing director of Moelis Australia in asset management. John is an equity specialist and has over 18 years of experience in financial markets across property investment sales, equity research, sales trading, and risk arbitrage. Over to you, John.
Thanks, Phil. Welcome, everyone. I'll just try and get my technology going. Just bear with me a second. I do have a slideshow here.
We get Chris Monahan back.
Yeah. Let's just try this. Can you guys see that?
Yes. Well done.
All right. Well, it's not working yet. Let's see how it goes. All right. I'll just give a quick overview of a little bit about the capital markets, and then I'll talk a little bit about my career. And a little bit like Grant, I've kind of chopped and changed a few things. I did the property course back in 1991, moved to Sydney, and I worked at UBS for close to 14 years before joining Moelis, where I've been at Moelis for about 10 years. The real estate capital markets, just to touch on them, the last 20 years, we've seen a huge increase in the amount of assets that have been securitized around the world. More recently, we have seen an increase towards private ownership. Guys like CBUS and a lot of big pension funds around the world have been kind of going direct and buying direct assets. I think it's important to remember that real estate does compete with other asset classes. So, when people are looking at where to get returns, they're kind of weighing up all types of asset classes, and kind of comes back to what Phil said about understanding, it's a small part of real estate's a small part of the whole picture of investing. So you really got to have an understanding of not just real estate, but the next comment there, you understand where cash rates are, what global bond markets are doing at the moment. Particularly after COVID, we've got global rates trading at record lows, and rates which no one ever thought would happen are actually trading negative, which has big implications for asset pricing. And that last, should be any surprise to anyone, COVID's obviously had a massive impact on real estate and on the REIT market. And that chart there at the bottom is a chart of the S&P ASX 200 REIT index, which is effectively the Australian Stock Exchange's real estate investment trust index. And the red line is the American equivalent, which is the S&P 500. Actually, it's a Bloomberg REIT index. It's like the S&P 500 REIT index. It was going along quite nicely until about mid-February when COVID hit, and you can see it got absolutely belted, fell about 50%. Now, to put that into context, in fact, I think it actually might have fallen 60%. To put that into context, that'd be like walking down the main street of Sydney, office building sold, 2 weeks ago for $100. The guy's trying to sell it to you for $38. I mean, it was quite incredible what can happen in real estate capital markets. Historically, real estate capital markets have been pretty defensive for obvious reasons. Normally you have long-term leases, and when you have a crisis, the bond market tends to rally, so interest rates collapse. We haven't seen that. The global financial crisis wasn't overly kind to real estate. A lot of these REITs had too much debt, and we went into COVID thinking that real estate would be a pretty good place to be, but as you guys might know, there's question marks over whether leases were unenforceable and whether tenants had the ability to pay. And one thing that markets hate is they hate uncertainty. And there's a saying that in times of uncertainty, correlations go to one. And that effectively means that assets just all move in the same direction in times of panic. And you can see that chart at the bottom. It's a chart showing three of the major major REITs in Australia. They all fell, you can see from kind of mid-Feb, they all collapsed, pretty much fell in line with each other. And it wasn't until people started thinking about what are the implications for the different asset classes that they performed differently. And I think Grant made the comment about logistics Logistics are doing well. People are worried about, what's happening with office space. Are people going to come back into the city? And there's obviously question marks about shopping centres and the implications of habit change to e-commerce. Unlike the typical physical transactions, real estate trusts are priced daily. With physical assets, they're valued infrequently, and there's a low level of transactions. And certainly at the moment, we don't have a lot of evidence for kind of the direct value in terms of what asset prices are going to do, because sellers are understandably cautious about putting things on the market, and buyers are also pretty cautious at the moment. But you can see there, the blue line shows the Goodman Group, which is industrial. Stock got smashed. It's back. It's now trading 30% above where it started the year. The red line is Dexus, which is the big office REIT. That's still trading at about 25% where it started the year. And Shopping Centre Australia is trading about 17% below where it started the year. So there can be some big moves within asset classes.
John, can I just interrupt for a sec? Given that some of the attendees might be first-year students and could be, in fact, first semester students, or study periods as we call them, could you just describe what a REIT is?
Yeah, well, in simple terms, all a REIT is effectively is it's a trust structure that owns physical real estate that is traded on the stock exchange. So, if you wanted to set up a REIT, you might set up a trust structure. Let's say you went and bought an office building. Say you paid $100 million for that building. You'd put it into the trust structure. If you decided to issue 100 million units, for example, then each of those units would, start off trading at $1, and they would be traded on a daily basis on the stock exchange. So, and I'll talk a little bit about the difference between physical and REITs in a minute, but that's effectively what a REIT is. A REIT is it's a securitized or a listed ownership of owning physical assets. It's as I said, it's traded on a daily basis. Transaction costs are very low. If I wanted today to go and buy, say for example, Goodman Industrial Trust owns a whole heap of industrial buildings, kind of sheds around Australia and in fact around the world. So you get different types of REITs. Goodman is a specialist in owning industrial. Dexus specialises in owning office buildings. So if I look out the window, there's probably 5 buildings I could point to that are owned by Dexus. And Shopping Centres Australia owns different types of shopping centres. So it's kind of a way for investors to get exposure to different types of real estate asset classes.
Thanks, John. That's great.
And just, I mean, you guys are, probably aware of direct property transactions. I'm sure, or hopefully you've learned the basics of valuation, where, we talk about willing seller, willing buyer, having an arm's length transaction. When people deal in real estate, they tend to act knowledgeably. They're long-term holders because transaction costs are high and frictional costs to trade in real estate are high. You might have to pay stamp duty as well. So transaction costs are high. We call that low liquidity. Liquidity being the ability to buy and sell an asset. Direct property tends to have low liquidity. REITs have very high liquidity. You can transact in large volume. I could go out there today into the market and sell $5 or $10 million worth of Goodman Group without a worry in the world. If you wanted to go and sell a $5 or $10 million property, direct property, it would probably take you a month or two. It had to be advertised on the market, and then you'd have to have a tender process or an auction. There's fewer comparable sales, so these REITs are trading daily. There's volume that's transacted, and the other thing is there tends to be less emotion because the prices don't change. Prices aren't going up and down, as you saw in that chart before. People. We'll get to it. There's a lot of people that transact in the REITs that really don't understand the underlying fundamentals of what they own. Theoretically, prices should more likely reflect intrinsic value, and intrinsic value really is just that calculation that you guys would have learned or be learning about the present value of cash flows. So what is the present value of the cash flows of an asset? Just discount the cash flows back, and that gets you the intrinsic value. And theoretically, they should have low volatility. Those question marks are there really just because of what we've seen in COVID is, maybe some assets won't reflect intrinsic value, and they might be a little bit more volatile than in normal times. Unlike listed real estate, which we also call the REITs, a lot of participants in that market are they're emotional and they're uninformed. There's a lot of short-term traders. The participants might be leveraged, so they might have margin loans from their stockbroker accounts. Many participants take their cue from the share prices. So, it was pretty evident in that chart before where you saw all of those three REITs fall 50 or 60%, and then Goodman Group is actually up this year, is that a lot of participants in the market would just be looking at the share prices. They don't really understand what the underlying assets are, and they panic in times of crisis. There's different motives, like people own these REITs for a whole heap of different reasons. A lot of the movement is what's called flow related. So you might have situations where people on a wholesale basis decide they just don't want to own real estate anymore, and so they will sell it, not really anything to do with the fundamentals. So when you get a few people doing that at the same time, you can find that the exit doors tend not to be wide enough, and stocks can get hit pretty hard, not reflecting fundamentals. As I said, there's generally high liquidity. Transaction costs are very low, so that tends to mean that prices diverge and can diverge significantly from intrinsic value. So when the price of GMG and Dexus and Scentre Group, when their share prices collapsed, the underlying valuations of those assets wouldn't have changed too much. So the valuers would have, they might have tweaked them here or there. There wouldn't have been that much transactional evidence for them to change those prices. Warren Buffett, who some of you may have heard of, probably the greatest investor over the last couple of 100 years, he made the comment that the stock market will offer you opportunities for profit percentage-wise that you'll never see in negotiated purchase of a business, and you can basically apply that to property as well. So you wouldn't have seen the AMP or Lendlease or any big owner, any big REIT come to market and dump the shopping centres or industrial buildings, and having been sold for $100, you wouldn't see them being offered at $38. Just wouldn't happen. It would take a long time for that to happen, and probably wouldn't happen. John Maynard Keynes, though a famous economist, made the point that the market, and I mean the stock market, can remain irrational longer than you can remain solvent. So this mispricing can last for quite some time. I know the other boys took up a bit of time, so I'll try and kind of get through this quickly. But as I said, there's completely different market participants. If you're dealing in direct property, you've typically got, the likes of CBUS, the pension funds. You might have private equity. You might have other REITs that are active in the market, buying and selling physical real estate. When you enter the world of the stock market, you get all these other characters that are starting to play, and many of these participants have no idea about the real estate they own. They'd have no clue, in fact, where any of the buildings are, who manages them, whether they're trading cheap or expensive. And some of these are passive funds and index funds. You guys might have heard of, you can put your money, say for example, people thought real estate was a good place to be. You could just go and buy the index, which would be a basket of all of those REITs. Similar kind of investor is an ETF. There's participants in the market called high frequency traders. They buy and sell shares. Sometimes they deal in nanoseconds and deal in microwave speed. So they're not really trying to buy and sell a REIT, for the underlying property. They're just trying to buy it, thinking it might go up in 20 seconds and sell it. So all of those participants, which I've highlighted in the red there, they really are not active in the direct marketplace. So there's, understanding who the market participants are, what's driving the market, can provide some real opportunities. How do you make money in securitized real estate or in the REIT market? Hopefully you can see it does require a different skill set. Fundamentally understanding what an asset's worth and the intrinsic value of an asset is absolutely critical, because over the long term, prices do reflect that. In the short term, they reflect a whole host of other things, such as emotion and the psychology of the markets. As I said, prices often don't reflect fundamentals. If you can understand what's driving people's decision making, there can be an opportunity to arbitrage the direct real estate market. And an example of that would be when the property REIT market collapsed. If you had a strong view that Goodman Group, GMG, which was the industrial REIT, you had a strong view that they would be a beneficiary of what was changing in terms of e-commerce and logistics demand. It was a great opportunity for you to buy stock at a very, very cheap price that you just wouldn't get in the direct market. There are a number of factors that will close the gap, because the real estate trust should really reflect the underlying assets of the real estate. And if it doesn't, there's an opportunity to either buy those units cheap and wait for them to reflect the value, or maybe it might be buy the units cheap and sell the physical assets that the REIT owns. So there are a number of what's called catalysts, which can either close the discount to what the fundamental value is, and REITs will try and implement this from time to time. If they think their stock's too cheap, they might implement buybacks, there might be takeovers, and there's lesser amount of catalyst to close the premiums. There's a group of investors called hedge funds that sell things that are expensive, hoping that they'll go down. They can be actively selling stocks. And if things are trading very, very expensive, so for example, if industrial property was trading at a 50% premium, you wouldn't be surprised to see all the investment banks going around town trying to find industrial assets to deliver into investors. My career role, a bit similar to Grant. I've done quite a number of different things. I came out of the property course. I think Justin Blaise mentioned the Securities Institute course. I did that as well. I started with a small property developer in Adelaide doing commercial and industrial property. I moved to Jones Lang, where I was involved in commercial and industrial property sales. In about 1996, I became a REIT analyst at UBS, where I wrote research reports about REITs that I thought were good to buy and REITs that were good to sell, and we sold them we marketed those to institutional investors. After about a year of doing that, I moved out onto what's called the dealing desk, where I spoke to institutions and advised them on the stocks that they should be buying. So things like General Property Trust, Stockland Group, Westfield Trust were big names back then, and we were just buying and selling baskets of securities for those institutions. Kind of got a bit bored of that, and so I moved into not only doing, I kind of used the skill set that I learned in real estate, and I think real estate is a fantastic skill set to understand how to actually value any investment. It doesn't have to be real estate, like Grant talks about doing private equity and also about infrastructure. It's the same kind of framework, and that's one of the great things about the course, is it really helps you understand how do you value an asset. And so I use that skill set to specialise, or to basically become a generalist, and which I talked about all sorts of, BHP, the banks, pretty much any type of listed equity investment. In 2007, I moved across to the hedge fund advisory desk, where we moved in not only in advising people on how to make money by buying things, but also how to make money shorting stocks. So trying to make money when things not only go up but go down. And then in about 2 years ago, I moved from an advisory function into what Chris Monaghan talked about on which is the buy side. And now I look after a fund that invests in REITs in Australia, and also look after a small companies fund, and we invest in all types of small companies, technology. That we own some REITs, a whole heap of different small companies. So the skill set you'll learn in the course is, I think you can take it into a lot of different areas. And just a few things that I think are worth thinking about in your career. You want to, as coming back to Warren Buffett, you want to define what your game is. Doesn't matter what you do, whether it's investing or in your career. You really need to have an edge. You need to have something that stands out, something a little bit different. My advice would be, don't look for the money, look for something that you love. I think Grant made that comment as well. If you're good at it, the money will come and you'll do well. You'll also enjoy it. Stanley Druckenmiller, who is one of the world's greatest traders, he made the point, if you're early in your career, really look for a great mentor. And I was fortunate enough to really start with Andrew Pridham, who I'd met when I was doing the course and was in Sydney, and I worked with him at UBS, and later I moved across to Moelis, which he runs our business now. So finding a great mentor and someone that can kind of, you know, guide you in your career is very useful. And Warren Buffett's offsider is a gentleman called Charlie Munger. He's 97 years old. I think Warren Buffett turned 90 this year. They're both still happily running Berkshire Hathaway, so this can be a very long-term career. Unlike most careers, it's actually cumulative. If you keep learning, you'll keep improving. And he makes the point that turtles that outrun the hares are the learning machines. And I think you know, the world is changing constantly, and it's imperative that you know, once you finish your course, you just keep you know, you keep learning. I look at every day as an opportunity to learn something new. That's it, Philip. I hope I didn't go over too far.
No, you did well, John. Thanks very much for that. And look, you know, for those that are viewing this, you know, we've been talking to some highly specialised, highly successful, and dare I say, highly paid people in the property industry, all of which are stressing this issue about continuing learning. So obviously that means the university for a start, and then it never really stops. But your talk was really interesting in this direct and indirect. Oh, can you unshare your screen, John?
Oh, sorry. Yep.
That's all right. No, it's now a distinction, not a high distinction.
Sorry, Philip.
That's all right. But this direct and indirect opportunities to invest in property, and I suppose, and you're implying this, of course, when you're looking at and analysing a REIT of your own volition to advise others, then I guess you'd be looking at those direct properties, but within this indirect vehicle. And so it's an incredibly interesting area, and come back to those sort of that pricing, and as you say, the mispricing. So it'd be, I'd imagine your job would be a lot of fun at times, saying, "Wow, this is cheap," or you know, "This is dear," and backing it up with all your skills that you've accumulated over the years. So, John, thank you very much indeed for your time. Okay, our final speaker today is Chad Hermson. He is Portfolio General Manager for Retail for QIC Global Real Estate. He's also studied at UniSA. I think it was the MBA that I might have read there, and was also involved in a student mentor program some years back. Chad's current role is managing the leasing teams and strategy of key assets of Eastland, Watergate Garden Town Centre, Woodgrove, as well as the JV partnership assets of Merrifield and Claremont Quarter, WA. He's had more than 13 years experience in national and internationally in the leasing space of some major products. So, Chad, it's over to you.
Okay, can you see my screen?
Yep, you did well.
Okay, brilliant. That's step one. Now I've got to try and work out. I've made mine a little bit tricky, but we'll see how we go.
Okay.
So good afternoon, everyone. I'm going to start off by talking a lot about retail. So retail property is changing, and I think there's no doubt that as we've spoken about with the volatility at the moment, there's quite a bit coming up. The largest shopping centre in the Southern Hemisphere is Chadstone Shopping Centre, which was built in 1960. In 2019, Chadstone had total retail sales of 2.1 billion. In 2017, the total retail sales of all Australian shopping centres combined was estimated to be 141 billion. And to put the changing retail landscape into context, an online company that started in 1994 when I was 14, in 2019 had nearly triple all of Australian shopping centres combined sales from 2017, 384 billion, which was Amazon, which probably more concerning was the fact that they were trading at 20% up on the previous year. So today I'm going to talk about three things. And the first is that a career is like a game of snakes and ladders, much what Grant said. It's rarely ever a straight line. The second is about my journey into property, which is probably very, very different from some of the others, but again, takes a very similar path that it doesn't have to be straight via uni or straight via a property game. The last is what I've found to be important along the way. And when I was asked to come and provide career advice, I recall talk I gave back in 2004 when speaking to Year 7 students, funnily enough, on the same topic. My achievements to date as a 24-year-old at that time included 2 failed attempts at university to complete a degree, no real career plan beyond 12 months, and I was just leaving a job I was successful at to enter a role I had no experience or qualifications in. And the question you're probably asking is, what gave me the confidence to talk to students with that sort of track record back then? And whilst taking risks and networking and even some luck, played a part, I think the key ingredient for me since an early age was that drive to always be looking for a role that excited me, and that passion that we talk about. So with a little bit more experience under my belt, lots more mistakes, and now I'm getting a lot of the grey hair coming through. I hope a short snapshot of my pathway to property and what I'm now genuinely passionate about can help some of you feel more confident and comfortable, and hopefully more excited about your journey ahead. So my first job started out working in retail, funnily enough, for Coca-Cola for Woolworths at the age of 15. Here I experienced my first management position, where at the ripe age of 20, I was managing a team of over 60 staff. I learnt the good, the bad, and the how to fail very quickly. But it was here I found a love of sales, and eventually it led for me to having 2 offers in sales roles with Coca-Cola, Amatil and GlaxoSmithKline, or Kleenex, some of you might know them. The toilet paper role paid much more, but I went with a role that I knew I would enjoy more and I'd be more passionate about. And I guess in my early 20s, I had several fantastic sales roles in account management, business development, from FMCG with Coca-Cola to media with Triple M. And from here, I jumped into banking and finance with 2 roles as a BDM, and all here in Adelaide, which was probably a great grounding for me at the time. And I guess what was common with these roles, aside from the sales focus in each of them, was the skill of adapting, that personal growth you get by transferring skills from one industry to the next. And it wasn't about chasing the money. And the good thing is, both Grant and John have also said the same thing, is that, in my experience, is if you follow your passion, money will come. And I guess the test for, what you're passionate about is very simple. When you wake up in the morning, will this job make me jump out of bed, or, will I be pressing the snooze alarm? Now, my big opportunity into property really didn't take place until 2007, when, or after I moved to Dubai, and the drum roll here is without a job. So some might say a bit stupid, others probably too risky, and you can imagine what my parents were saying at the time. So when I landed in late 2007, bad luck struck twice when the GFC hit, and here I was trying to make a name for myself, hunting a dream job in probably the worst market. So a tough lesson was be prepared to make mistakes, but probably the more important lesson was be prepared to overcome them. So fortunately, after multiple unsuccessful interviews, I landed my first property role as the Group Sales and Business Development Manager for the largest shopping centre group or company in the Middle East, MAF Group, in their leisure and entertainment arm. So I guess selling a product that consisted of theme parks, indoor skydiving, and one of the largest indoor ski centres in the world was exactly the role that would get me up early in the morning. A year later, that role expanded to include leasing, which was probably something I was a little bit hesitant on. Leasing, I believed at the time to be a little bit too one-dimensional for my current role, and also something I wasn't necessarily jumping at. But from an unknown, my leasing career slowly took hold. It was also in 2008 that I started another journey of personal investment when I had my third crack at university, and when I commenced my MBA with UniSA. And finally, after years of, looking, I realised I had a passion for business and being involved in all areas of it. Starting and completing a degree, whether property or in my case an MBA, provides a foundation, in my opinion, for working in property. Most things in this game don't come quickly, and being there from start to finish is a key ingredient for the resilience that you'll need throughout your career. The second lesson, and probably as that second quote says, is a tough lesson I learned, is that in Dubai you're actually paid based on your education, not just on the role that you had, and that was by law. So 3 years after moving to Dubai, my wife and I returned to Australia, and I commenced role as a leasing executive back in the country. After moving to Melbourne, I was fortunate to work on 2 major projects, being the $1.2 billion Melbourne Emporium project, followed by the $600 million Chadstone development, spanning a 5-year period. My first head of leasing role came in the start of 2016 when I commenced work for one of the wealthiest private families in Australia, the owners of a large portfolio of retail assets. Here I oversaw the completion of the Pacific Werribee $400 million development and several small developments that the family had at the time. The family went on through a sale process to sell 50% of their major assets to actually my current employer being QIC. Unfortunately, as part of the sale process, QIC brought me on to oversee handover and settlement, which has seen my role since expand further. So QIC GRE, my role consists, and that of my team, is just one function in a very large business. And to put it into context, QIC manages approximately $80 billion worth of funds under management with approximately 900 staff globally. The GRE side of the business has approximately $20 billion invested in real estate with 12 assets in the US and 24 assets, as you can see here, based in Australia. To understand where we sit, I guess this gives a bit of a scale of the opportunity within the business. And where we sit in the organisational function chart. From our managing director, we have Michael O'Brien. We have 7 business units, including funds management, strategy, business technology, sustainability, and asset management. The Australian arm is where my team sits, and it's also the largest team within this direct team. Under our director, there are 6 business units covering the various functions from operations, strategy, safety, marketing, and asset creation. And it's here where, under my manager, who has one of the largest teams that I sit, under my role here, I look after 5 of the 24 assets with a team of 13 leasing executives, as well as additional support staff from lease administration to legal team. So I guess portfolio general manager of retail, what is it? What do I do? My role is to lead the leasing operations strategy and development functions across both Victoria and Western Australia. In addition to managing a team of leasing executives, the role focuses on key relationships, one being our joint venture partners on assets where we have joint owners, and the other is with our key retail partners such as Accent Group, who are the owners of Platypus, Hype GC and Skechers. The key objective for the role is to deliver returns for our investors. And as we see it, we have 3 customers. Obviously, our investors and shareholders, our tenants, and probably the least and probably least spoken about is our customers to our centres. So whether for retail services, retail, or an experience-based visitation, by generating the right offer and mixed-use environments, we can maximise the sales and footfall in our centres to generate income for our tenants and thereby increasing the value of our assets and returns to our shareholders. And really it's done by 2 methods. The first is maximising income from the existing operations, and the second is really to create value. The difference between these can be best explained as the daily operation versus the redevelopment. Maximising income is where my team and I have a deep understanding of the assets and the demographic and execute the leasing strategy to budget with the best retail mix that generates long-term value for the asset and for our tenants. Creating value is master planning with our development team, looking for opportunities to develop an asset where the best of supply and demand can be substantiated. So if I were to sum up, what property has provided me and what it's enabled me to achieve, I'd probably have you here all day, like many of the other presenters could. And I certainly don't have the experience that some of them do in terms of what they've done. I see that mine's still very much in the early stages of a career, but I've been fortunate enough to experience quite a lot, both in Australia and overseas. But having had the opportunity to work around the globe, meet and work with people and some amazing individuals, and I guess have some influence on some quite significant projects, I'm quite humbled by what's been given to me and what impact I've been able to have. So I guess the question of how do you enter? For me, the good news is that working for QIC or really any major property group can be via many different avenues. And there's a great opportunity with a diversity of roles available, as you could see previously. From a leasing perspective, a passion for retail in all its forms, as well as, of course, a strong sales focus, and certainly good analytical skills is fundamental. So growing in the role requires a want and a desire to continue to improve and challenge yourself. When I was young, it was always about getting my goal or getting to my goal. But probably what I've come to realise is that the game doesn't end, remembering that it's actually about the journey and not the goal is a really important bit. I think the challenges that are there, and there's not many more headwinds stronger than where we sit today. Online was a headwind which has been accelerated between 5 to 10 years with coronavirus, that a lot of landlords are having to diversify and adapt at a rate quicker than we have before. But being an individual that can adapt is really, to any situation is really key in this industry. And, my favourite saying has always been, get comfortable with being uncomfortable. So, what does QIC look for? QIC, like most companies, looks for individuals that not only meet the skill sets required, but help us build a strong culture. I think individuals who have a willingness to learn and, importantly, a passion for the industry is really key. I believe it's also important, and I think both Grant and John could probably testify to this, is that having experience outside of the industry and in other areas is actually also fundamental, because I probably wouldn't be where I'm at today had I not had that retail experience early on, for example. And I guess my last point probably relates to burnout. I think particularly more so now where we see the pressures of roles come into play. And there's a lot of pressure that all of us experience over our careers. And there's probably 2 points that have helped me through my time. One is find your purpose. We don't work simply to make money and buy things. I think find that driver above all else that that you can see as your passion, and find your purpose and dig deep for it. And, mine, for example, and it can change, is, to hopefully try and give back in some way, to others, over the course of my career, which is something I've been really strongly focused on over the last 12 months. The second is probably to be resilient. And this is really key. I think resilience is never giving up, and be willing to, keep moving forward no matter the challenges. Resilience, I've found, has been strengthened by having one key ingredient, which is gratitude. So gratitude provides a foundation, for life and for great leadership. If you can be present in the now, and grateful for what you have now, you'll find that you'll actually do your part in creating the right culture for your company or your business or your team. And it'll also create a lasting personal success for yourself. So I guess in summary, and I've tried to be as quick as I can, hopefully today, my stories help some of you understand that it's okay to not know your path, as long as you keep looking and keep, pursuing. And I'm happy if anyone's got any questions to connect with me afterwards. So thank you. And I will stop sharing.
Well done. That's fantastic, Chad. Thank you very much for that. Yeah, you also show a lot of humility, or as a good friend of mine says, humility. I like that. And being comfortable with the uncomfortable. I mean, that goes with student learning as well. And I suppose in the end, resilience kind of means a bit of toughness too, that we have to ride with the punches and have our passion, to keep our passion intact, I suppose, and to go on that career path. So look, I really appreciate your comments there, and it's quite an exotic area. I mean, I have been to that centre in Dubai. Was it Dubai or Abu Dhabi?
It was Dubai, yeah. Yeah.
I've been all the way up there. I could get up there. So thank you very much indeed for that. So we've got a few questions we'd like to put in summary. Grant, there's a question here. What kind of skills do we need to have applying into fund management career pathway?
Yeah, often it's not necessarily going from uni straight into the funds management business world, or uni straight into investment banking. You might find yourself going sideways but forward at the same time. But to answer the question more directly, a really, really inquisitive mind, your ability to look behind the obvious. Every meeting you attend, don't ever sit there as a passenger. Your mind should be absolutely constantly moving with 3 or 4 questions in your mind that you are really eager to ask. And if you participate strongly in every meeting, you've got to keep on learning. But a big part of our role in investment management is that inquisitive mind. We have to keep on learning, but we will invest with a manager And it's never set and forget. We're constantly monitoring that manager, constantly monitoring the assets, because things are constantly changing. So yeah, I suppose that's my high-level comment.
But no, thanks, Grant, because that's more of, again, of an attitude of inquiring, and I suppose we need to ask questions not only that might confirm our views, but maybe in fact against our views, and then come up with an informed decision. So thank you for that. Now, Chad, this might be a good one for you. Another student, is it sufficient to begin an institutional fund career with a finance degree? Well, actually, this question is more related to international. What are the requirements for entry-level job? Does the industry welcome international students? That's probably what I'm getting at, because you have been overseas and perhaps more empathetic for international students.
Yeah, I think what you'll find, and again, I probably did it back to front by going over there without a job. But look, the reality is, there was fundamental planning that you've got to put in place. The biggest thing is to learn where you're going and what the opportunity is. Forget, the career path you want to take, because I'm sure, as Drew and Grant can say, that there are different climates in different countries, and what in Australia isn't the same. So I think there's always going to be an appetite for people that are willing to make the jump. I see having had it as international career as a really good stepping stone for people, because you've really got to jump in the deep end. And I think ultimately, for students wanting to do that, the first thing I would do is, do your groundwork, not on what you're looking for, but on the country you want to go to, understand a lot about it. I mean, there was a lot about the Middle East and Dubai that I had no idea until I arrived. And, thank God I was able to probably stay in there and hold myself together. But there was a lot of learnings that you just don't know. There was a great book that I wrote when I went to Dubai, which is called Don't They Know It's Friday? And it's the most simplistic book about life in the Middle East. But I think depending on where you go, the first thing is to understand where you want to go. There's no doubt that, if you're over there, that it is seen as, both education is seen as certainly a high thing. And I'm talking about, the Middle East. And then probably the second thing is anyone that's willing to come over there, I can say that there's always going to be an opportunity. You've just got to be willing to look and be resilient, because, if I look back at my time, I reckon I would have gone to, 15 job interviews, applied for probably 30 jobs. And it's not that you need to take everyone, but you've got to put yourself out there to understand, to learn. And so I guess my advice is, yes, there always is. The market will probably dictate what's there, but you've got to do your research. And more importantly, you've got to be willing to, hit a lot of dead ends and a lot of brick walls, but to keep going, if it's what you want to do.
Yeah, thanks, Chad. Chad, we are confirming all the time of this incredible breadth of opportunities for our students, and you've confirmed, in your example of working in Dubai, and many others have similar stories. John, there's a question here. Would a further qualification in finance on top of the property degree be of significant benefit? Not for you, John, but for students.
It's a good question. I certainly did the Securities Institute course, and then I did 2 years of a course called the Chartered Financial Analyst course. I think my views probably changed over the years. That I think that it doesn't necessarily have to be finance. What I'm looking for is someone who's curious, someone who's passionate, and even people with different that have learned different disciplines. Can be very useful, because they think about different things in different ways. So I think that's, I don't necessarily, it probably looks okay. It probably looks good on your CV, and if you have the Chartered Financial Analyst, it's probably helps get you an interview. But it's interesting what what I look for. I mean, it comes back to a bit like what Grant said: is you're looking for someone who's curious, or you need to be curious. You need to try and see things in a different light than other people. Otherwise, you're going to get the same results as them. I mean, to give you an example, I was asked to speak to a guy a couple of months ago. He'd come out of, he was actually a professional AFL player, hadn't really studied any finance, but I think he was studying philosophy and might have been doing the first year of the CFA, but I sat down with him, and he was so well read on, you know, all aspects of finance that you could see that he was just so passionate about it. And you know, to me, that's the, you know, the type of person that, you know, I would look for, someone who's really got a passion. And I just make the point that it's worth reaching out to people. A lot of people, you know, if you send them a note on LinkedIn, can I have a coffee for 5 or 10 minutes? I don't think people, you know, people are always happy to talk about it, and, you know, sit down and try and help you. And certainly don't think because you're sitting in Adelaide that people in Sydney and Melbourne are a lot smarter, because we over the years, Moelis, and when I was at UBS, we tended to come down to South Australia as our hunting ground. Drew obviously took one of the guys out of your course, and you know, I think that's one of the things about, you know, people down that way, is they tend to be pretty hungry. So yeah, having another course and, you know, extending your study, but you know, I don't think it has to necessarily be in finance.
Thanks very much, John. Yeah, it's sort of reiterated all the time, this sort of underlying interest in property and passion for property and understanding how the markets work. And so we've seen all of these different variations of the theme in where we can extend our career paths. We've got about 6 minutes, and I'd like to ask each of you a really fundamental question, which has been provided by a student, and good on whoever the student is. What advice can you give me as a student? I'll start with you, Chad.
As a student, I guess it depends on where you're at in your career, or, you know, whether you're a mature age student. I was, you know, like yourself, Philip, I was a mature age student, and it probably took me a lot of false starts. So I guess my advice is, you know, is really simple. You know, I think Grant and John have said it, is look for your passion. If you're not waking up every day and excited about going to where you're at, then the reality is don't leave, but, you know, work out where you're going to go and find your passion. Because if you're passionate about something, you're going to work hard, you're going to enjoy what you're doing, and the results will come. I don't think it's meant to be complicated. There's, you know, if you've done all the degree, you know, if that's a qualification that's required, but if you've done the hard work, you know, so find your passion's probably my first thing. And the second thing is exactly what John just said. You know, I've made a career by networking with people. You know, the opportunities that I've had to career swap into different industries has come about by networking, and that is simply having coffee. You know, maybe it's virtual coffee. I now recruit all of my team, you know, and I've recruited 3 people this year that I've never met via, you know, video conferencing. So you've got to adapt, but you've got to keep networking with people. So I think, you know, if you've got your, you know, your passion and you know where you're going, even if it's, you know, you're unsure, you know, give it a crack. You know, don't ever, just because you don't know, just give something a crack, and, you know, do what you need to do in the background, but keep networking. And, you know, I think if you do all of those things and set yourself little goals, you know, and pat yourself on the back when you get a coffee with someone, you know, just a simple thing of getting a coffee with a Grant or a John or yourself, Philip, is a stepping stone. Because if you can aim to do that and then you keep hitting those targets, you know, things will happen, but you've got to be in there for the journey.
Yeah, thanks, Chad. We always reiterate to our students that so many of the people in property in Sydney and in Melbourne in pretty damn good jobs have come through here, or alternatively other universities with their property degrees. And generally speaking, they are really happy to help out. So the students that are listening to this, don't be intimidated by Chad and Grant and John. They would, I know they'd be seriously love to help you in whatever you might approach them with. So thanks for that, Chad. What about you, Grant? Just a simple message to a student that's studying property.
Yeah, I'd be looking to travel with your career. Don't be afraid to cross the border. And that's not because you want to get out of Adelaide. Don't do it for that. Do it because
Grant,
you see new opportunities more broadly. How's that? Is that better?
that is better.
Yeah, okay, all right. Yeah, so be prepared to travel when you're young and you haven't got many commitments. God, no commitments. Just get out there, and you'll find that the broad opportunities that are available interstate or overseas will be amazing. So you're going to increase just your opportunity set, and therefore your opportunity for success much more. Really concentrate on being a communicator and the ability to influence. And that's not to be in people's faces and be a pain in the ass with your personality, but genuinely know how to communicate and get your message across succinctly and with some degree of underlying knowledge and experience. And thirdly, I remember back when I first qualified, I joined the Australian Institute of Value as a land economist, currently the Australian Property Institute. And I was pretty active in the social events and whatnot. I was the editor of the newsletter there for a while. I joined the South Australian board and whatnot. And I think I put that down to why I got my first gig at Funds SA, which effectively launched my institutional investment career. So yeah, be prepared to invest in your networks as well.
Thanks, Grant. Yes, in our first year, one of our first year subjects, we introduced the students to the API, of course. We now have the young property professionals where they meet every now and again. There's the sprinkling of knowledge and the sprinkling of drinking, and it's all good communication. So to say, students have to be kind of, as I said, get engaged in their field, and their field happens to be property. And I suppose what you're all saying, unless you're pretty excited about after the first 1 or 2 years, well, then maybe you should be thinking about something else, because it's an industry which can provide a lot. But I guess whatever industry they go into, they need some passion to drive them to bigger and better things. What about you, John? What about a concluding word of wisdom? Well, words of wisdom.
Well, I think it's been pretty well covered. I mean, I'd say keep asking questions. Always say one of my favourite quotes is, "There's no foolish questions, and a man only or woman only becomes a fool when they stop asking questions." So, you know, don't be afraid to put your hand up and ask questions. Certainly, I think that networking and reaching out to people, you'll be surprised. Not many people, you know, I might get 2 or 3 people a year might hit me up on LinkedIn and tell me they're looking at something, and then you kind of, you know, you can build a relationship, and then maybe I might say to them, well, you should go and try this person. And, you know, the number of people that have ended up in roles because, you know, they go into an interview and they can say, I know X, Y, Z, and I've met them. And it just shows a level of passion. And, you know, you need to have something that, stands out. You need to have an edge. So, you know, for example, if you wanted to work in a property in private equity, then, you know, I'd be learning about Blackstone, I'd be learning about KKR, I'd be learning about the history, looking at transactions. So when you're going to talk to these people, you know, you can interact with them, and you know more than you know, just what you've learnt in a textbook. A lot of people just, you know, turn up at the interview process and regurgitate what they've learnt at uni. It's you know, it's a breath of fresh air to find someone that's you know, is really interested and has been learning outside of your typical studies. So that would be my advice.
Thank you very much, John. Look, Chad, Grant and John, we thank you very much on behalf of the students and behalf of fellow academics here and the university for your time and your passion shown, and I think it's been quite inspirational. So we thank you very much. We look forward to welcoming our attendees back tomorrow to hear about infrastructure and data centres and career advice from the top for post-COVID graduates. If you haven't registered for this webinar, the link is on the original email invite. So we're going to call it a day. Thank you again very much, and good luck. Cheers.